Hey, what's going on, everybody? Welcome back. So, I got something special here for you. I got Kelly Green, and as I got a little note here, it says she is the senior editor of Yield Shark at Mauldin Economics. At 20 years old, she graduated with a degree in mathematical economics, but she quickly realized she wanted to do more than prepare information packets. She wanted to dive deep into analysis. I can't even talk. I'm trying to read this with a straight face because I'm like, you're sitting there, but two more sentences. Now she researches dividend stocks and helps investors when not analyzing dividend paying companies. She's a certified yoga instructor who rides motorcycles, and we also discovered that we share a love for punk music. So Kelly, stealing your thunder, welcome to the channel and the show and the podcast, and we're going to talk some dividend stocks.
Sweet. It's exciting. It's super exciting to be here, especially, someone who's, on the younger side of the dividend investing world and, likes punk music.
Yeah, we were talking before, and I was like, if we would just talk in this, it's super exciting for us. It would just bore the hell out of everybody else. So, actually, I just read your new newsletter today, and it's fantastic. So, let's just start there real quick. So, is it a free newsletter? Can anybody sign up for it? How often does the thing come out?
Yeah, so I have a newsletter weekly called Dividend Digest, and that comes out every Wednesday, and that one's free. If you don't like getting extra emails, you can subscribe on LinkedIn so that you get notifications there instead. And then I have like a more premium service called Yield Shark. That comes out weekly as well with updates. And then every month I pick my favorite dividend stock right now. And we kind of keep an open portfolio of that. And I keep track of that for you. So every week I do the weekly updates. I go through all the earnings calls. I do all that heavy lifting. Earnings season just kicked off. I'm really excited to do a deep dive into 33 earnings calls. That's what I live for. So,
But you enjoy it. You enjoy it, right?
Yeah.
So I got to ask you, what is a degree in mathematical economics? Because I like economics. I'm terrible at math. So when I couple those two together, I'm like, this sounds like something I wouldn't be very good at. So what is mathematical economics?
I mean, my degree is in economics, but so I went to a state school, and the really interesting part is like the economics program is like 30 credits, and then you just got to take like whatever you want, but it has to be econ related. So, while people are taking like, easier economics class, I was taking econometrics where you do all the statistical analysis by hand. I was taking, differential equations. I was taking industrial organizational economics. So I was all about all of the math. I just want to be like have multiple like chalkboards and like show you how the economy should work without the government. And then we got to put those horizontal lines where the government makes floors and ceilings. So like, that's what interested me in economics.
What was that movie, A Beautiful Mind, right? With all the chalkboards and all the numbers swirling around it. Well, I'm glad we have people like you because for me, not so much with the math. Not very good. Cook County educated, but hey, they definitely made me SMRT smart. You exclusively write about dividend stocks over there. We'll just start off there. What makes a dividend stock worth considering, and what are your top three? Yeah, or whatever. How many do you want to share? I don't care. What's your some of your top metrics that make you look at, or that you look at first?
The interesting part is like, I'm all about the numbers, but then when I talk about dividends, I like to talk about the story. So it's always funny because like I do look at the math, but the story is what always excites me. When I like screen for stocks, the first thing I care about is the dividend yield. And I am more of like a stickler than a lot of people in the industry. Like, it's funny, I even looked through your portfolio, and so I was like, that doesn't pay enough yield. That's not enough yield for me. Like, I'm such a snob when it comes to yield. I really aim high. I like to do 3.5% is like my bare minimum. And when I'm screening, that's the first thing I do is I want to know the dividend yield. And that'll still give you a couple hundred, stocks. The next thing I do is I try to take out things that, have no volume or ADRs or foreign stocks that might have tax withholding. I mean, they're not bad, but I don't like dealing with the tax withholding because I'm like, cool, I make 7%, and then this country is going to hold 25%. And then you start doing the math and you're not getting as much dividend. So I look at the yield, and then I also want to look at the dividend history. And it's again where I'm not necessarily a stickler about always increasing, but I don't want to see cuts. I don't want to see the dividend yield all over the place. I mean, there are some stocks where that makes sense, But generally, even if you've been steady for like 10 years, I'd rather like I'm not going to kick you out for being steady. But when you see like the dividend yields all over the place, I'm like, that's not. So those are the things that I really look at first, because again, we're here for dividends, for income.
So you're primarily trying to build those passive income streams through dividends and just like the dividend snowball, right?
Yeah, and that's what so my portfolio is like designed in two like silos, and I really try to oversimplify everything. So like my whole theory is that you can only do two things with your investing money. You can build wealth or you can create income. Like that's it. So like when we build wealth, that's that snowball, like reinvest, and that's where you do want the increasing, because you're going to hold that for 10 years. Like a lot of the stuff you have, I'm sure you anticipate like holding for decades. They're companies you're going to hold for decades. But then in the current yield section, which I consider like the passive income part, I look for higher yields, a little bit more risky. We might only hold it for 2 years, right? My short-term hold of 2 years, which everybody makes fun of me. Like my short-term holdings are still years. So yeah, but I'm always looking, we got to have that dividend to do either of those things.
So like BDCs, maybe something like that.
I love BDCs. Yeah.
Business development companies.
Mm-hmm. Yeah, because you've got, I noticed you have Aries, which is one of my favorite, ARCC. Yep. And I got some others that I really like. Hercules is great. Hercules does a lot of like tech and life sciences. The cool part about BDCs right now is, it's not the cool part. They're struggling. So I think that's the cool part, because their share prices are down. So that means we can get a good price, right? Because when price goes down, yield goes up. So I personally like to see when a sector that I really like is struggling, because analysts are overlooking it. It's cheap. And again, if I'm going to hold for 10 years, cool. I'll take this. Struggle's not going to be 10 years.
And not only that, but when the share price drops, share price drops, dividend yield pops, but also you get the benefit of lower risk when you can buy at a cheaper price, and you have lower risk and I guess higher upside total return potential as well. Real quick, I love how you said the story, because great Morgan Housel, probably everybody knows Morgan Housel, how he has a quote: every stock price today is currently a number multiplied by a story about tomorrow. I seen that actually today with Starbucks. Starbucks had a kind of a not very good quarter, their Q1 for their fiscal year, and I was like, okay, they're probably going to drop tomorrow. I go on StockTwits sometimes because I'm a little bit of a degenerate, I guess. But everybody there, like, that's it. Buying puts, shorting Starbucks, they're going down. That's it. And they're up 8% or something today. I have no idea why that they did. I guess everybody's excited. So like you said, the story, right?
See, I got to just call you now. My friends are so tired of me geeking out about this stuff. So, but once, the new CEO took over at Starbucks, and I was just like, again, I felt like the crazy person with like all my diagrams, but I was like, it's going to be interesting. It's a story. I have the Starbucks gold card, right? I've been drinking Starbucks since college, but it's different. It's more expensive now, can he change it, right? What is he? So he's got all these plans. As somebody who can't tolerate dairy, like, yeah, it's nice not paying 60 cents for the extra for the milk, like, but will that be enough for like the consumer? So it goes all the way down to the consumer, the story. Because like, if we have no consumer, we have no company. And so like, we can look at the numbers all day, but if like the people that we go out there and talk to them, like, are they buying Starbucks? Because if the answer is no, then we have a whole different problem, no matter what the numbers say.
But it's all about that story. So speaking of CPG and food and whatnot, in a recent newsletter, you talked about Wendy's 6.8% yield. It's a Baconator-sized yield. They got a 100% payout ratio though. So Kelly, can you break down why payout ratio matters and what numbers should make investors like us cautious?
Yeah, payout ratio is not perfect, and there's many ways to do it. My mentor has like this crazy formula he uses, and I'm like, bro, it's not that serious. Just use dividend payout ratio. So it's just total returns over net income, or easiest way to do it is dividend per share over earnings per share. And it's like how much of the company's earnings are being paid out. We want to say that companies can't pay out more than they make, but most of us have credit cards, and we are paying out more than we make, right? If a company's paying out 100%, that means they don't have any left to reinvest in the business, and they don't have any for a rainy day. So that's why I'd be wary of something at 100%. A company like Wendy's is going to be able to go to the bank and be like, hey guys, we need a little more money. It's not super concerning for Wendy's now, but when we get up to 125 and 150. But it's also concerning on the other end, right? So when we have dividend stocks that are paying out only 20% of earnings, you're like, well, I guess I'm not important as a shareholder, right? So like, what are you doing with the rest of that money? I want to be considered important. Like paying me is important. So, I think it's always kind of been, we look for that sweet spot, like 50 to 80, like that's where most of the time you're getting your biggest bang for your buck as a dividend investor.
And so there's a white hot raging debate always about, but there's really not. It's just within my mind there is between earnings per share payout ratio and free cash flow. I'm more on the free cash flow payout ratio because I think that's a little bit harder to fudge those numbers where, earnings per share can be a little bit financially, manipulated and massaged. So where do you come down on that? I mean, are you more of a EPS gal or are you free cash flow?
I think, like you said, the numbers can be manipulated. You're right. Free cash flow cannot be manipulated as much as our earnings. And,
well, they can do it, but people might go to jail.
but that's the other thing. Like, look at ADM. They've Archer Daniels Midland. They've been manipulating data for like how many years now and tying it to management bonuses. And like, that sucks, but they're still the biggest grain producer ever. So like, I'm still like, we should buy them. Even though like the number, we don't even know if the numbers are right or not, but most of what we, like if you look in your pantry, most of that came from ADM. So I think it's more like good to use as it doesn't matter which one you use, it gets scary when it gets high. At the end of the day, like, I don't know. Again, I'm not, as weird as my degrees in math, I'm not a stickler for the numbers all the time.
Hey, but that's the funny thing because the numbers don't exactly tell you what's going to happen. No, nobody knows. Like, what do we say? The future's unknown and it's unknowable. So, the numbers are nice, but I think Warren Buffett, sometimes I think I'm in a cult. I'm in a Warren Buffett cult where he said if accountants knew what was going to happen, then accountants would be the richest people on the planet. They're not. So it gives us all a bit of a chance that we can compete with them. And what I want to touch on your point too about, I was in PepsiCo for a while and, sold out of them, but their payout ratio, free cash flow payout ratio, which I like, was over 100% for a little bit. I actually emailed them. They emailed me back and they said it was because they're investing for the future. So that's where that was dropping their free cash flow per share. Coca-Cola was well over 100%. So some of the big blue chip companies, I tell people it looks like they can sustain that for, a couple years, but you can't be 4, 5, 6 years well over 100%.
But that's a really important point, is like to point out to people, okay, so companies make money. There's only 3 things they can do with that money. So I'm a company, I got my earnings, I can reinvest it back into the business, I can save it for a rainy day where it's making 0, or I can pay it to shareholders. Tech companies are going to have a lower payout ratio because they have to reinvest heavily into the business. We saw it with Intel, right? Intel had to cut its dividend because it woke up one day and was like, shit, we're behind because we've been paying out dividends instead of making chips better. PepsiCo and Coca-Cola have been paying out so much to shareholders, they're like coasting. So then they wake up one day and they're like, well, shit, maybe we should do something better. Let's take out an extra loan. Oh, well, now our payout ratio, is high because we're, using debt to do this. But again, it's like, we're going to buy Pepsi and Coke products. They'll do it for a while and it'll be fine.
They're not going anywhere. It's like, as long as the brand, the fundamentals, the core brand is still intact. I mean, it might get a little bit battered. And hey, you got the distinction as far as my brain can remember. I think you're the first guest to swear on the program. So no need to apologize. That's going to go to you for always and forever as this thing keeps going around. So, and who better than to have a punk rock chick do it too. So I really do appreciate that. Thank you for making that. So we're going to get to the next question here. There's some, I do want to ask you a question. There's a book by Adam Cecil called Where the Money Is, right? I think he wrote it about because why do bank robbers rob banks? That's where the money's at. And in the book, he made a point about when tech companies they don't have the same exact R&D structure, I guess, right? I think that they can't, maybe you can help me out of that. I'm drawing a blank now, but it was something along the lines of when PepsiCo spends money on R&D, they are able to, I think, capitalize it. But when a tech company does that, they cannot when they spend on whatever they have to do to grow the business. I can't believe I forgot that, but it affects their some of their financial ratios.
Oh yeah, because it's not tangible. Most of what they do is not tangible, right? Because how long will it take us to see it? So Coca-Cola creates a new flavor, right? And then they make it so that you can only get it if you're, if you tag some Instagram account and only 500 people get the new flavor, right? Or whatever happens, they do some scheme about it. They make it really, desirable. People sell it on eBay and all this great stuff. Then they release it to, only Publix. So like they play these games, but you can say like, this was the R&D for, Dr. Pepper Cherry, and each can of Dr. So it's tangible, right? And when we talk about tech companies, it's like, we figured out how to do something a millisecond faster. And you're like, cool. Is that putting more money on the balance sheet yet? It's so weird. Like, how do we measure that? We could, but it's, until we're selling them, it's not measurable.
Yeah, and that's why I think they get some of these, some of these outrageous valuations could make sense because we could be in a new, paradigm where it makes sense for these tech companies where they aren't so capital intensive and they have IP and they can really leverage that. And then I always like to say, for me, that's kind of why I've not really played in the individual stocks with like semiconductors, especially like the chips, because I have a tough time understanding what makes a Intel chip suboptimal to an NVIDIA chip, which makes that superior to a TSM chip. So that stuff, like I have personally a hard time wrapping my head around that. But what I do understand is potato chips. Like I understand like Cheetos, Fritos, Tostitos, Lay's, PepsiCo, they have all the Eatos. And I understand that when you put a Dorito chip against like the Kroger brand Dorito, it's not even close. And I'm like, oh, here's the moat. Like you can understand that moat, so I'm like, well, now they have problems with RFK. We don't need to get political potentially, we'll see what happens. Anyway.
That's a whole nother rabbit hole. I love, like, I have a lot of food allergies. So like, I love talking about like food dyes and alternatives that are going to cause allergies. See, that's a whole nother tangent. We could do a whole hour on that too.
Put it this way. Some of the food companies like Hershey, PepsiCo, they're going to have some headwinds to navigate here. So you teach people about making their first trade. So what, Kelly, would be your step-by-step approach? Or, I don't know. You don't have to give us exact. For someone who wants to start investing in dividend stocks, how do you set them on the path to the straight and narrow?
So I have a free dividend quick start series. It's like 4 videos. You can get through it in like 30 minutes. It's laid out to be like, this is what dividends can do for you, right? I said like you can build wealth with it if you've got time, really easy, compound it. Does not take long for compounding to work. Or you can create more passive income, right? To use the money now. And then the second one, I walk people through step-by-step how to set up a brokerage account. As simple as it is, it's also overwhelming because you're like, you sit down and you're like, okay, I know my name, I know my birthday. I got to find my driver's license number now. Sometimes they have security questions where you need to like match your whatever with old account. It can be a lot. So we go step by step how to set up a brokerage account. Because like that's step 1. You got to have an account. And then I give 2 videos that say like how to do the wealth building and how to do current yield. And I give 2 stock picks. I have this theory when I'm teaching yoga. Because I'll have students who have been with me for however long, and they're like, well, I'm still a beginner. And I'm like, you're not though. I have a theory. When you come to my yoga class, you're a beginner for 3 classes. I give you 3 classes to use that excuse, right? Because you show up and you're like, which way do I put my mat? Oh, I got to take my socks off. What is this lady saying? Second class, you're like still kind of confused. By the 3rd class, you're just doing yoga. It's the same with investing. Like it's so easy to read, we can read Intelligent Investor 17 times, right? We can follow Warren Buffett. We can do all this, but like just trade the stocks. So it's like, get the brokerage account, go to your website, go to my website, go to see what Warren Buffett trades, pick somebody, read their reasoning, and find one that resonates with you. Not everything I say resonates with everybody. Like not every article is going to resonate with you. Find an article that resonates, be like, I'm going to buy 10 shares of that one, 5 shares of that one, 1 share. And then like, look, you made your first trade. Like that's it. Like just start. And like people always say, oh, I'll wait until I have $10,000. I'll wait until, I've read all these books. Like just do it. Just trade the damn stock. See, I'm gonna keep swearing on the podcast. That's why
I love it. No, you got to start because, and you also, I would add, you want to make mistakes. You're going to make mistakes. I mean, it's undeniable. You will make mistakes, but that's how we learn from our mistakes. And it's better to make a mistake with a little bit of money instead of a mistake with a lot of money.
And make them now, because like, if you wait for 10 years, now you miss 10 years to like get that money back that you lost. Because I see that like people waited so long to start. And I'm like, you could have made the mistake and then been on, like learned the lesson and been on to the next best trade by now. Like, so just do it.
I wish I would have took that advice. Sometimes I've found, and I still struggle with this, where it's better, if unless it's something you have high conviction in and you're going to hold it for a long time. Like I'm kind of struggling right now, but I'm doing it with Next Star Media Group. That's one that I felt like I did so much due diligence. I understand it, like everything's there, and then it just does not do what I expected it to do. So the market's telling me something. The market could be wrong, or it could be me that's wrong.
But I think that's important to point out, though, is like the irrationality of the market, because we have to remember that like the value of our share, there's two values of it, right? There's the value of your Pepsi share. If Pepsi goes under tomorrow and like they liquidate, they're probably not going to send you like 100 bottles of Pepsi, but like you're going to get like, you get some money from them selling off all the Pepsi, right? So that's one value, but the whole other value is the market value, which is what like investors have like made up in their mind what it's worth. So like you could run all the numbers on Nexstar. You're like, this is it. This is what it's worth. Like if the company went under tomorrow, I get a check in the mail for this much when they sold off all their, office chairs and pencils, right? The market undervalues it. So it's hard sometimes like balance those two in your mind, like, because they are two different things.
Well, being a contrarian, some of the biggest money is made being a contrarian, but it's also one of the most lonely places to be when you're a contrarian, and you're a contrarian for a while on something until everybody catches up and they're like, oh yeah, they were right. So, hey, like I said, I'm either going to learn a lesson or I'll be right. So either way, I guess it's a win-win. It's a good way to look at it. But all right, so also options, wanted to touch on this. I noticed you do something about how do you get in beginner investors started with options? When do you recommend options? What are your thoughts around when you teach options?
So it's funny you say this, because like I feel like someone leaked you some company calls, because I got something brewing, right, that I'm hoping to share with everybody at the end of March, because
don't say too much, don't spill the beans, but
because I haven't done options in so long. But I think the important thing to know about options is like most people are buying options to speculate or to create insurance for their trades, and that's important. Like most of the stuff that people read about the options market is speculating, or they're creating a hedge. That's not what we do. Like if you want money, you don't want to do that, because we want to be on the other side of that trade. Because the same thing with options is like there's a buyer and a seller. We want to be the seller. Yes, options are this, but that's not what we're doing. I like to say like we're the casino, like we're the house, right? So these people are out there speculating or creating hedges, and like we're the house, and the house wins most of the time. So you can really set up, cover calls. Like we're talking about cover calls to generate more income, right? And that's, like I said, I got some stuff brewing. Or if you're a little bit more advanced, like selling puts and creating income, and your worst case scenario when selling puts is like you put the shares and you're like, oh, cool, I bought shares I already wanted to own, and I'm in the red on paper because the shares are down. Like, oh, darn, I'll collect my dividend until they recover. So it's, I love options, but I just stop reading the scary stuff, because those people aren't doing the fun, like the income generation side.
Oh God, yeah. Yeah, I mean, I was reading recently that Gamblers Anonymous is now there's a deluge of Robinhood people that are going over there because it's like, mainlining crack cocaine is trading options. Like you can make a lot of money really quick, but that's the gambling. That's the speculative part. And, I dabble with selling covered calls too. And for those of you that are listening, if you're selling a covered call, I'll just go the most basic way. You have to hold 100 shares of the company to be able to sell the option contract. It just gives somebody the option or the right to buy those shares from you at a certain price and a certain date in the future. And there's a way to do it where you will lose no money on the option contract. But anyway, so yeah, I just thought we'd touch on that because it's an interesting thing that, some people do it, some people don't. But yeah, and then like you said with your puts, you can get paid. That one you don't need to own 100 shares, but you can get paid to wait for a stock to get to a price you'd like to buy it at. And if it gets there, then you're assigned the shares, but you need the money in your account.
Yes, cash secured. Charles Schwab will give me an ungodly amount of margin. Like it's not okay how much margin they'll give me.
I don't use margin. I'm too scared to. My friend Warren and Charlie told me not to use it. My friends Warren and Charlie.
But that's the thing is like that's another like and if like people watching this want to go like do some options on their own. I always think like really 3-4 months is kind of the sweet spot where you can get the most time decay. Don't trade short-term ones. So if you want like a tip for me, if you're dabbling in options, look at like 3 to 4 months because you're going to get time decay, and then always make your strike price so that you're going to profit if they're called. So like those are my 2 tips for covered calls.
Getting into that theta burn, we're going to lose half the people that are listening talking about theta and delta, and we could talk about anyway. I know I enjoy it. I was just telling you I'm reading this book called Get Rich with Options because there we go. Mark Lichtenfeld. Oh, I took a it came out in 2006, and
I used to work for Agora. I was like, that's an Agora book. I've seen that.
Is it? It is. You're right. So Mark Lichtenfeld wrote Get Rich with Dividends, and in that he recommended this book on options, which is funny because it came out in 2006. He updated it in 2009, and in one of the examples, he's talking about an option contract. He's like, so Microsoft is trading at 27.50, and if we sell the 12.50 deep in the money option, DITM, I was like, oh, buddy, like I know the future that you don't know it, but you should have just bought Microsoft and said to hell with the options, just plowed as much as you could. I mean, obviously it was less certain then, but you could have just held on to it. And the last thing I'll say on options that I've learned, and this goes out, shout out to my guy Derek on the Dividend Talk podcast, is that he says he learned he's gotten burned. You only mess around with options for stocks that you know you want to get stuck holding because something could happen. It could move against you. And now you're holding those shares. So make sure you want to own those companies. So one more here, and it's going to revolve around Innovative Industrial Properties, ticker IIPR. This is another one that I recently sold out of. In your yield chart, your subscribers saw 24.5% gain. So I'd like to know if you could walk us through some of the analysis or just some of the surface level reasons that made you decide it was time to exit that position.
IIPR is interesting because like I want to be bullish on cannabis. It's not for me. I get too weird. But like, I want to be bullish on it because as a libertarian, I think people like adults should be able to do whatever they want as long as it doesn't affect everybody else around them.
You're speaking my language. Yeah. I didn't know you're a libertarian too.
Yeah.
Beautiful. So don't hurt people and don't take their stuff, right?
Yeah. It's so, and you know, you can look at Colorado, how much tax, the revenue they're generating from it, cannabis is like great. The thing about IIPR is it's a REIT, so it's real estate investment trust. And they have these properties all over the US that have to deal with like cannabis cultivation. The interesting part is the licenses are attached to the property, not the company. So not only they own the property and licenses, so I really like them. The problem comes to, there is a point in every real estate investment trust's like existence, right? So REITs have to legally pass through most of their income to unit holders, which is, you know, why we love them. They have above average yields for the most part. Okay, so our dividend is at some level. How do we get more dividend? Well, they either have to increase the rent or buy more properties. Well, they're not going to increase the rent because these guys have 30-year leases. So like that's out of the picture.
And also, I would jump in here real quick. They also did sale leasebacks, right? Where they would buy the property and then lease it back at a really high rate, which was kind of capitalizing some of these businesses because they couldn't get loans because dealing with cannabis and all that. So raising the rent is really difficult for them, if I understand that right.
But I mean, it's so cool that they found that like niche, right? So the cannabis companies couldn't get loans. So the cannabis companies just bought land and then sold it and then paid the rent. So it makes sense as like a business model, and it made sense for the industry. The issue now becomes the cannabis, like the workings of the cannabis market, right? We've had so much legalization, and it was interesting to not see legalization happen here in Florida because everybody's smoking pot on every corner. There is a dispensary on every corner, but you also have to renew your prescription every 7 months and pay the doctors. So like, why would they want recreational legal? Because there's a whole economy based on this. So there's like, you know, again, I didn't bring my tinfoil hat to this, so like we won't go through all that. But there's a point where they weren't buying more properties because the industry was not growing. That's why we got out, because share prices, like they stalled at like, I recommended to sell at like 108 or 110, and then they ran up to like 135. Yep. But now they're down to $66. And that brings up a good point. We shouldn't stress about the, you know, $15 we didn't get. We wanted to make sure that we didn't lose the $60 that everybody else lost. Their largest tenant is defaulting on the rents. And they're only defaulting on certain properties, but due to the terms of the lease, they're considered all in default. And this is not IIPR's first rodeo. They are going to get litigious. Basically, in the article you're referring to, I got asked if now's the time to buy again. Probably, because if you look at their how much value, like if they sold off all of their real estate tomorrow, what's our value? Well, it's good, but now the rents are going down, so that property's going to sit empty. So that means our dividend's probably going to get cut in the short term. But do we think that cannabis properties are going to sit empty? I don't think so, right? I don't know.
And that's one of the things that I sold, because I don't know if they'll be able to bring in tenants, because from what I understand, they have a really high square footage rent, but are they going to be able to bring in a new tenant and they'll be able to pay that super high rent if they weren't part of that sale leaseback and kind of don't have that cash? So yeah, it's something I held IIPR for a while. I bought 10 shares close to $200, watched it go all the way down to the 60s the first time around, and I loaded up like 40 some shares. So, and then when it went back to around 100, I took my profit on those and I kept the 10, and I watched those go in the 130s. I'm like, well, it's almost back to, it's probably gonna anyway. So
I mean, and there's like the issue is like the licenses, right? It's just like liquor licenses. There's only so many. Like the county only gives out so many, and we when somebody loses their liquor license, everybody lines up to buy it. These cannabis licenses, so like if you want to grow, you have to be in a licensed grow facility. So it's going to come down to, are people still lined up wanting those licenses? That's the question. So I think if we wait to see what IIPR says on their call, and it looks like they're going to be able to flip those properties in 2 quarters, I might recommend getting back in.
It's a lot of uncertainty. And again, it's just, when I see all that uncertainty, I was like, you know what? I'm out. I took a big loss on those last 10 shares. I got some dividends. So it cushioned the blow a little bit, right? Like putting a pillow in front of your face if Mike Tyson in his prime is hitting you. So it's still going to hurt, but maybe not as much as a bare fist hitting you. But Kelly, is there anything we haven't talked about that you think is of importance that maybe we should cover, or anything you want to talk about?
We've talked about, REITs and BDCs and all those fun things.
Can you share some of your favorite stocks? What are a couple of your, not like a stock pick thing or whatever, I don't know. You don't have to give any of your content away, but what are some companies you enjoy, you like?
Everybody gets really, really funny about my love affair with EPD. That's been my favorite stock for like 12 years now.
Do tell.
I love EPD, Enterprise Products Partners. It's a pipeline company, and people love to speculate on the price of oil. I hate speculating. I like to buy my stocks, and then I like to be in my convertible or my motorcycle, or I live in Florida. I like to be at Disney. Like, I do not want to be watching the market when I don't have to be. So I like pipelines, because like it doesn't matter what the price of oil is. Like, it's got to move. So EPD has been one of my favorites, and it was funny because I was on a panel at the Money Show. And the guy on the panel was like, I don't like EPD because it has no like capital gains. And I was like, that's why I love EPD, because it literally just trades between 20 and 30 like forever. It has for the last 10 years. And I just, when it gets closer to 20, I lock in 9%, and when I buy shares closer to 30, it's still 7%. But it does have tricky tax things. So if you get an MLP, some people hate the tax things, but I like pipelines. EPD is my favorite.
That old K1. Yeah, it's funny, and I'll add on that with because I went through something with EPD. I had held it for a while. I held EPD and Energy Transfer, ticker ET. And the mistake I made was I held them in a Roth and a self-directed IRA, which, I did a video on it. And it was funny, during a live stream, one of the viewers was like, why do you hold them there? It's the wrong place. I was like, well, the tax treatment. He's like, I don't think you understand. So that got the ball rolling. And I love sharing this stuff. It was a little humbling, but I looked and I was like, oh yeah. So what I did, I ended up selling EPD and ET, and I put it into ticker MLPX, which is the Global X MLP and Energy Infrastructure ETF. It basically holds all the midstream pipeline companies. So I still got that exposure, and that's done really well. But there's no K1 with that. So yeah, you're paying a little bit of a higher expense ratio. I think it's like 0.35%, but you're not getting the K1, and it's a little bit easier to deal with the taxes on that. So
did you actually have enough to get hit with the UBIT? You got hit with the
No,
penalty?
no.
Okay.
I think I had 150 EPD in each account, so 300 shares. So yeah, it wasn't enough for to
Yeah,
trigger
'cause
that.
I'm not a big ETF person, but I do tell people if you want oil exposure in a tax advantaged account, go with the MLP ETF.
Yeah, and it was just the easy button for me, and I still wanted that exposure, and I also thought it was a little high, but in the my taxable account, I got my eye on EPD, and I'm hoping there's a sell off. So I'd love to hold it in the taxable account because right when the you don't pay taxes on the dividends until it's either time to sell, which you can bequeath it to your heirs. There's a fancy bad religion Greg Graffin word. You can bequeath it to your heirs and they'll get the stepped up cost basis. Or when your dividends go all the way to zero, bring the cost basis to zero, then you'll start paying taxes on that. But yeah, fun little things nobody ever taught me and I never knew. So I got my eye on EPD. I'd like to own it once again. Well, I guess I still do in the ETF.
It's interesting. It does not go higher than like 32 many times, and it's right up there. So it's due for a correction. But even at this price, it's still 6.36%. You can't like turn your nose up at 3.3, 6.3%. Like,
yeah, that's beautiful. Same thing kind of with the two BDCs I own, which are Main Street Capital, and which has just been a ridiculous cash cow. All I do is I get these dividends and these or is it's a distribution, right? No, it's
yeah.
a dividend.
No,
Is it a
yeah,
distribution?
it should technically be a distribution, but yeah.
Yeah. Oh, well, we'll call it a dividend. I get these dividends and special dividends, and the share price just won't stop going up. Yeah, obviously, you can't do that in perpetuity, but my cost basis is in the mid 30s with Main Street Capital and factoring in. I think I did the last time I factored in all the dividends and special dividends. I'm at like $29 cost basis. It's just, and I'm like, damn it, why didn't I buy more? Stupid not being psychic.
That's always how it is, right? You're always like, oh, why not buy more? Oh.
Thought I had time. Like with the low yielder you were talking about, Visa, I was buying that in the 260s. And I'm like, yeah, I'm okay buying it here. I'd like to really pick up a lot more in the 240s. The damn thing's pushing $340 now. It's just, I bought it for the growth. I thought I had time to accumulate, and it's been one of my best performers. My tea's gone cold, and unless you got anything else to say, you don't want to tell the people where they can reach you if they want to email you, what on your socials or whatever. I'll have links.
Yeah, so you can find me if you Google Mauldin Economics, Mauldin Economics. Dividend Digest is my free letter. And then Yield Shark is my paid letter. And then, like I said, I think I might have some new stuff coming at the end of March. Or you can find me on social media. I go by Down Dogs and Dividends. Yoga and stocks. I'm on LinkedIn. All that fun stuff.
I'll have links to those to your socials and everything. How is John, by the way? Do you ever get to talk to John? Thoughts from the front line. I've been getting that newsletter for a long time. Sometimes it's over my head. Sometimes it's really long. I'm like, it's a Saturday morning. It comes out on Saturday. The man is like the Death Star of economic information. I'm like, I gotta Google this. Hold on, and then I'm like, man, I've spent an hour on this newsletter. I'm learning. It's great, but it's a little intimidating.
He's always out gathering new information, right? He's always traveling. He's always gathering information. He's like all about like longevity stuff right now, and he's tried a lot of it himself. He's got such great stories. So it's funny because if you're ever on like a call with him, he'll bogart the whole call, but he's got such great things that you're like, this man is just full of knowledge. Like you said, you're like, sometimes like my eyes glaze over, like he's lost me. I need to Google like 10 of these things. But yeah, I love thoughts from the front line too. So
all right, good. Well, at least that makes me feel better that somebody like that is much smarter than me sometimes gets the glazed over eyes with John's stuff. So yeah. Well, I guess we'll end on a high note there, Kelly. So hey, we'll do it again. You're always welcome to come back, and it was a pleasure.
It's been fun. I'm definitely going to be texting you all the time now.
Good. Hey, not a problem. Same with you. Some of my friends, like people I work with, and it's just family members, relatives. I talk to my cat sometimes about dividend investing, but he's a good listener. He's a good listener. So, all right. Well, everybody, thank you for sticking around to the end, and we'll catch you in the next one.